All right, listen, guys, we are live. I am super excited. Welcome, welcome, welcome. At the end of the day, guys, this is the Mortgage Wise Radio Show. And this with my wife and I. I'm Randy and have my wife Veronica with us. And the purpose of the Mortgage Wise Radio Show is to provide education and expert advice on personal finances and mortgages, including real estate investing, right? And so over the years, our team and I have helped hundreds of first-time home buyers, experienced home buyers, and then also real estate investors achieve their dream of home ownership. And so today, guys, I'm just, fired up, to be working with you, to be able to share this information. And I'm Randy Chambliss. If you haven't figured that out right now, I am the executive director of Louisiana Housing Authority. I'm also a corporate branch manager with a very large national mortgage bank. And I have to my right.
I'm Veronica Chambliss. I am the director of housing at Louisiana Housing Authority, and I'm a corporate branch manager at Geneva Financial. So guys, today we're going to talk about first of all, there was an article that appeared on NOLA.com. We actually had a different topic, but we wound up changing it because the article came out this week. The name of the article was New Orleans homeowners risk foreclosure than any other major U.S. city. So, of course, guys, that's near and dear to us because personally we can relate to it. Also, we from New Orleans. This is our hometown. So, I mean, that was huge.
Yeah, I agree. And, so this is going to be a good topic. It's very, very needed because we have some things coming down the pipeline in 2021. That's going to be almost another pandemic but so we got to be able to stay in front of it, right? So listen, this is a piece of that article, right? So listen up. The New Orleans area has earned an unwelcome financial destination during the COVID pandemic. More homeowners here are at risk of losing their homes due to unpaid mortgages than in any other major American city. More than 1 in 10 borrowers in New Orleans and metro area are now at least 30 days late with mortgage payments and could be at risk of foreclosure on their properties, according to the federal data. The risk isn't spread evenly either. Data from the Federal Reserve from earlier in 2020 showed that forbearances and mortgage delinquency rates in zip codes like 70127, which includes New Orleans East, are about twice the metro area's average, whereas those in areas that include Old Metairie and Mandeville are closer to the national average. So that was just a little snippet of that article that we had read earlier. My wife and I love to read and love to stay abreast of what's going on in the community. And so that's why we wanted to come on here. So at the end of the day, guys, Veronica mentioned that this topic is near and dear because we went through a pre-foreclosure challenge, right? And so back in 2009, 2010, when we had the mortgage crises, we was one of the ones that got caught up, unfortunately, in that as well, to the point I had lost income, right? And so at that time, I was about 2 months, 2.5, close to 3 months behind on my mortgage, right? I bought my first home out in Slidell, a little small 3-bedroom, 2-bath, 1,200 square feet home. But I was behind on my truck note, and I was also behind on my mortgage. And I remember the day when the sheriff knocked on my door, right? Prior to that, it wasn't that serious to me, right? It wasn't that big of a deal to me. Like, okay, I'll make up the payment, no big deal. I'm talking to the lender like, hey, no problem, Mr. Chambliss, we're gonna work with you. Just pay us when you can, send us a little, a partial payment, etc. So I'm thinking everything okay, right? But it wasn't okay because they lied to me. The sheriff knocked on my door, handed me a piece of paper and said, are you Mr. Chambliss? I said, yes, sir. He said, here you go, you're being sued. And I'm like, well, for what? And of course, I got angry, I got defensive. And the guy was like, listen, I'm just the deliverer of information, right? So I said, okay. So, I took that information, started calling my bank, my mortgage company, and trying to figure, hey, I thought you guys said you was working with me. But at the end of the day, this was one thing after another. I never got any clear answers to that. And so at that point, I was mad, I was frustrated, I was a little bit embarrassed, right? Because here am I working my butt off, had a lot of goals, a lot of strategy, a lot of dreams, and here I find myself behind my mortgage, getting ready to lose my home with a family, right? So you could imagine almost depression is going to set in because you don't know what to do, right? So we started researching, getting some information, looking at some foreclosure defense strategies and et cetera. And then my wife, she came across some information. You want to share what type of information you came across?
Yes. So I came across, I just was online searching. And I'm like, you know what, Lord? I'm like, it got to be a way out of this. We got to be able to get some kind of help. So I just started going online, just researching, looking at different options. And I called my husband. I was like, look, because we got to the point where we had to make some decisions
Quickly.
So we didn't know if we wanted to pay the mortgage, put food on the table, pay the children's tuition because they were in private school
Right.
at that time. And it got to the point, I mean, we were stressed out. So when I ran across the short sale information, because there are a lot of options that the lender, well, I'm not going to say the lender, the servicer of your loan does not tell you unless you ask. So how do you know what to ask? How do you know your options if you don't research and start digging and asking questions?
Right.
So I called my husband. I said, look, I say, I'm to the point where I'm stressed out. I don't like bills. I don't like debt. And right now, everything is in an uproar. So I ran across this information, called the bank and asked them about a short sale. So then
Right.
put the ball back in his court. He called the bank and they started working with him. And
Yeah, absolutely. So they told me what I had to do. I received a loan package for them, a short sale package, you should say, from the bank directly. And then I had to reach out to a realtor because you have to have a licensed realtor to be able to facilitate that, right? So I've done that as well.
And I'm sorry, I don't mean to cut you off,
No,
but I
go
want to
ahead.
throw this in before you go further.
Sure.
But I came to that conclusion and consulted with him because I wasn't afraid to lose my my home because I know you can buy another home, but I was more afraid of our family being torn apart because of it. So I rather, let's save our credit than try to, struggle and
Right.
try to pay this mortgage and making these big decisions and behind on car notes. So I'm like, let's just save our credit because when you do a short sale, you can purchase another home within 3 years.
That's right.
So
Absolutely. And so after I had that conversation with the bank, I talked to the realtor partner and they started working that short sale package. And I came across the investor. An investor came in and he was asking questions and we gave him information. And one of the things he told me, said, well, listen, Mr. Chambliss, say, don't worry, don't stress, because at the end of the day, this is 2009. You have foreclosures happening all around this community, everywhere in New Orleans, everywhere in Metairie, everywhere in Slidell where I was. He said, that's just the way it is. He said, but what you can do is learn from the process. Learn from the process. And then in the future, you can do the same thing I'm doing, help somebody else out to help them save their home or even purchase the home for them. That way they could save their credit, move on, and go buy another home. So that really stuck with me at that time. Like, you know what, right, at the end of the day, we could get this house sold. And so what we've done, we use, a good strategy. Well, my wife wasn't on that particular loan, right? And so we was building up her credit profile in the midst of everything that was going on, because it takes a good 4 to 6 months sometimes for a short sale to be fully approved. So we was building my wife's credit up, right? And then I tell you, no lie, it was amazing to thank the Most High God, because the day that we actually went to the closing to sell that house in Slidell was the same day that we was moving into the new home that we purchased by a FHA 203K loan, which means that we bought a foreclosed home from the bank, right? Repaired it, and it took us close to 4 or 5 months, whatever, to repair it. But the day we sold our house in Slidell and saved my credit, it was the day we was moving into our new home that was totally renovated with the colors my wife wanted, with the kitchen my wife wanted, everything that we had. So it was an awesome experience from the fact that we made a transition for the better. So we went from a 3-bedroom, 2-bed home up to a 4-bedroom, 2.5 home from 1,200 square feet to over 2,500 square feet, right? And so that was the transition that we made. And so we share that story with you very, very openly, because there's other people that's facing foreclosure, and you feel embarrassed, you feel upset, you feel that there's not a way out possibly. You worry about what people are going to say or what people are thinking. But at the end of the day, those individuals are not paying your mortgage. Those individuals are not paying your bills, right? So don't worry about what nobody thinks. You have to do what's best for your family, right? And so having said that, that's one of the reasons why we launched Louisiana Housing Authority, right? So Louisiana Housing Authority is a homeownership advocate. Number 2, a foreclosure prevention specialist. And number 3, a house buying organization, right? So the first thing, homeownership advocate, we provide education and tools and resources, and we make the connection with people so they can purchase their home. We inspire them and motivate them. That's the part of this podcast. We get people excited to purchase because they may not even know they can buy a home. The second thing is foreclosure prevention. Well, we want them to keep their home once they're able to actually get the keys in their hand. And so there's foreclosure defense strategies we share with them. There's loss mitigation strategies we share with them to help them to avoid and prevent foreclosure. And then lastly is the home buying organization. Well, we do purchase properties, we do rehab it and hold it for cash flow and help the community, or sometimes we resell those homes. So that's why the big passion came with Louisiana Housing Authority, because one thing we knew at that time when we launched it, right, was the fact that there's going to be a time, which is very near in March, that the forbearance plan is going to end, right? This forbearance plan is going to end.
Yeah, and they predicting it to be like a flood of foreclosures, similar to the eviction of renters.
Right, absolutely. So if you want a little bit more information about Louisiana Housing Authority, you can simply go to lahousingauthority.org. Again, that's lahousingauthority.org, and you can look at some of that information. There's video series that we created, probably about 10, 15 videos, short clip videos about the foreclosure process, what to expect during the foreclosure, some loss mitigation strategies, etc. So make sure you share that and let people know about those training videos. It's free, right? And so having said that, guys, let's talk a little bit about the mortgage. What is a mortgage servicer, right? Because that's critical to this piece. Veronica mentioned earlier, she said, no, I'm not going to say mortgage lender. This is the mortgage servicer. See, that's the difference between the lender and the servicer. The lender is the investor, really. Right? It's behind the scene. Most likely, you don't even know who that investor is. That investor put up that money for you to close your house. And then that mortgage servicer is actually the one that's servicing the loan, meaning that when you get that monthly statement, their name or their logo is on the top of that statement, and that is the servicer that's servicing your loan. They're the middle person between you and the actual investor.
Right, they're the people that's accepting your monthly payment.
Right. So at the end of the day, I learned in my personal experience that mortgage servicer was not on my side, right? They wasn't on my side. They didn't truly wanted to help me like they said they did. If they did, they would have actually helped me. But that's what a lot of misconceptions come, because we don't know the difference in our community between a mortgage lender and a mortgage servicer, right? So you got to know that critical difference. And so you have to also know the difference between a promissory note and also a mortgage, right? In Louisiana, we call it a mortgage. Some other places and other states is a deed of trust. But at the end of the day, in Louisiana, right, it's a mortgage. So when at that closing table, when you go and you purchase that home for that first time or the 30th time, doesn't matter. If you're getting finances, number one, you're gonna sign a promissory note. And that promissory note is just what it says. It gives you the amount of loan, the amount of money that you're borrowing as a loan. It gives you your interest rate. It gives you your term. And it's basically the promise that you're going to repay this back to the investor, right? That's the promise. Now, the mortgage itself that you sign is a document that probably had 20, 30 pages, right? Your hand get tired when you sign all those documents. And so that document is called a mortgage, right? And that document basically states that this is the terms that you agree to upfront. If you are behind on your mortgage payment, we get to use this tool, this mortgage, to sue you and take back possession of the house. And that's what a foreclosure is, guys. It's actually a lawsuit. The servicer go to the court, they file a lawsuit saying that they're behind, the borrower is behind. Here go the promissory note. Also, here goes the mortgage. They promised to pay. Here's the instrument. Judge, we want the house. and the judge will click that or hit that little gavel and say, okay, it's done. But a lot of people don't really realize as a foreclosure defense that you could attend the hearing, right? And you can contest that and say, well, listen, I'm behind, judge, because of A, B, C, and D. The judge is human. They're not a robot. So they may have some passion towards you and kind of slow down that process of that foreclosure or delay it for you, right?
See, and that's where a lot of people go wrong at. A lot of people get afraid of that process and they just let things take place instead of just showing up. Sometimes when you show up, then you get to state your piece. And again, like Randy said, the judge is human too. You never know what they're going through.
Absolutely. So when they hear your story, they may have compassion on you, right? And so a lot of times what happened is, like Veronica mentioned, we get passive. We stick our head in the sand like an ostrich and we hope the problem go away. The problem is not going away. They will foreclose and take your home. That's what you work so hard for. You do not want that to happen. So the first thing that you want to do once you recognize you're in this situation, you have to accept it. Once you accept it, now you have to go seek advice from experts that can guide you through that process to help you to avoid and stop that foreclosure, right? Now, having said that, that leads me to a defense. There's many different defenses that you can use during a foreclosure process. One of the defense is called the perfection of the chain of title, right? We talked a little bit about the promissory note and also that mortgage. The two and two go together. So oftentimes when you go to that lender and you close and you have those keys in your hand and you give your check, your down payment or your closing costs and everything, you get the keys in your hand. But what happens is that now that promissory note and that mortgage get recorded in the public records. And so when a servicer actually sells their servicing right to another lender, that's why sometimes you might close with ABC Mortgage Company, and then 30 days later or 6 months later, YZ Mortgage Company is your new servicer because they sold that debt to somebody else to service their loan. But the problem is, oftentimes, this was what was going on in 2009, 2010, and 2008. What was happening when that transition happened, when the loan servicer was changed, the promissory note and the mortgage deed, the mortgage didn't go with that new servicer. And so they were split. But the law states that you literally have to have both of them together. So if ABC Mortgage Company is going to sell their servicing right to Y and Z mortgage servicer, then both the promissory note and the mortgage have to go and be signed, right? Signed, both of them, recorded in public records and go with the new servicer. But what happened back in 2009, 2008, 2010, especially in Florida, it was just freaking crazy in Florida. And in California, that wasn't happening. The new mortgage servicer would try to go and foreclose on the house, literally take the house, right? But they didn't even have the promissory note, or they didn't even have the mortgage. So they didn't have the right to do that, right? Because there was no what? Perfection of chain of title. And so a lot of lawsuits were started and foreclosures were stopped and halted because the judge realized, hey, listen, you guys have this mill going on, this foreclosure mill going on. No, you have to have the promissory note and the mortgage together if you're going to decide, because here's the thing. How do we know that you are actually the owner of this note? How do we know that you actually the servicer? We don't know that anybody can walk up and say, oh, hey, listen, I'm the mortgage lender on here. I'm the servicer, right? Anybody could do that. You have to prove that. So that's a strategy I just wanted to share with us. Many other strategies, but definitely wanted you guys to know about that. So next, let's talk a little bit about loss mitigation. Like, what is that, right? So loss mitigation is basically, the word mitigates the lower the risk, right? The loss, lower the risk. Not for you as the borrower or the homeowner, but lower the risk for the lender, right? It's called loss mitigation. They have a whole department. The servicer have a whole department that's called loss mitigation, right? And so now within loss mitigation, it's basically trying to figure out how can the lender mitigate the losses to themselves, right? Now, keep in mind, you're most likely paying mortgage insurance, right? And this mortgage insurance is there that you pay this premium every single month in your escrow, and you were paying insurance for the mortgage servicer in case you default, they will cash in on the insurance policy. Go figure that, right? And not only that they cash in on that insurance policy, then they turn around, they go to the sheriff's sale, they foreclose, and they take the property back and then sell it and make more money off the sale. So don't feel sorry for the bank. The bank ain't losing anything, because once they get the insurance claim, once they get the money from the sale, now they're going to write it off on their taxes. So they're probably going to win when they take the house, right? Now, what you want to do is put yourself in a position where you know what these loss mitigations are. Like,
and I'm sorry, and by all means, the bank, they're not in business for that. They don't want that on their books. They don't want that, but that's just the process of them making sure that they minimize their risk. And that's the reason why, as mortgage lenders, we ask for so much documentation in the beginning to make sure that you are financially fit, that you're able to afford your mortgage, because the bank don't want to end up like that.
No, because they're investors. It's like loan cousin Booby $10,000. Right? Cousin Booby come there like, listen, I need $10,000 now. Okay, you want to know how you're gonna pay it back, right? And so you're gonna go through a process to make sure that he can pay that money back, right? So that's the same thing with the lenders from the institution. They want to make sure that they have as less risk as possible. And if the loan is not performing properly, meaning that it's not cash flowing for them, then they have to get rid of that or digest that debt. And they do that by foreclosing on the home, getting it off their book, and getting it sold. So that way they can have that money come back in, and then they can lend the money out again and keep that cycle going, right? Now, let's jump into some of these loss mitigation. I'm gonna give you 5 today. That's quite a few, but I'm gonna talk about 5. Number 1 is a repayment plan, right? The repayment plan is basically that you set up a repayment plan with your lender or with your servicer that allows you to pay that money back, right? And before I do that, let me kind of back up a little bit. I want you to make sure, if you're taking notes, write this down. The CARES Act, CARES Act, CARES Act. The CARES Act went into effect back in March in 2020 when COVID-19 hit, the pandemic came. And so we had to, when I say we, the powers that be had to stabilize the economy. And so one of the things they did, they lowered the interest rates. And we talked about that in our last podcast. Oftentimes when you have national disasters or global disasters, you will see the first thing the Federal Reserve do is lower the note rate. They'll lower the rate so banks could go and borrow cheap, and then they could turn around and they could give you interest rates for cheap, right? So also what they do is they put themselves in a position where they can, that is best for them, right? In other words, so in regards to what I was mentioning about the CARES Act, right? The CARES Act came into effect. Thank you. The CARES Act came into effect because they want to stabilize foreclosures, right? So what they did within that CARES Act is say, listen, if you was affected, meaning the borrower, right? Meaning the homeowner, if you was affected some way, somehow by COVID-19, you lost your income, you lost your job, etc., you can call your mortgage servicer and say, listen, I want to request a forbearance, right? And that lender had to, or the servicer had to approve it, right? All the way up to 12 months. And so what that did, that stopped the foreclosures from happening so aggressively. Could you imagine if that wasn't in place, what could have happened, right? People lost their jobs, no money coming in, the mortgage services are foreclosing, it would have been an absolutely disaster. So the CARES Act stepped in and said, no, we're going to give you forbearances, right? And these forbearances is up to 12 months. So some people had 3 months of forbearance, I mean, they don't have to pay not one red penny to the mortgage servicer in their forbearance period. Some had their forbearance for 6 months, some 9 months, and some of them had a whole year, right? And so what happens is after the forbearance ends and that process, that program ends, you have to repay that money back, right? And that's where the catch is at. Not saying it's a good or bad thing, but you just have to be aware that that money is not forgiven, it has to be paid back. So if you imagine for a moment, your mortgage note in principal, interest, and escrow, right, is $1,000 a month, and it's been 12 months you haven't made your payment, and that's $12,000 that you have to repay, or you at risk of foreclosure. So why the article that we talked about earlier, that why so many homeowners are at risk, is the fact that the 12 months is ending coming up this March in 2021.
And that article can be found at NOLA.com.
Yes, that article could be there. It'll be found there. And so now what happens is that people in March, either one or two things, either they're gonna have to pay that $12,000 back, or they're gonna have to use some of these loss mitigation strategies that we're getting ready to share with you, right? Because at the end of the day, the money has to be paid back. And so number one, it's the repayment plan. That loan servicer may allow you to take some of that back payment that you owe and have you do double payments. So if your mortgage was $1,000 a month for the payment, then now you'll be paying $2,000 a month. Your original mortgage, monthly mortgage, and plus the repayment of that extra $1,000. Some lenders some servicer may allow you to do half a payment, right? The extra $500 a month until you catch up. So that's an option, right? The second option is going to be a deed in lieu, which basically it's not a foreclosure, but it's basically you turning over your keys saying, here go the keys, I'm walking away, right? Don't foreclose on me, etc. The next option is going to be, which is a loan mitigation option, is actually a short sale. What my wife and I was sharing our story. And very simply, a short sale means that if your the debt that you owe on that property is $100,000, but all of a sudden your home is only worth $75,000, that's a $25,000 difference between what your value of your house is as is in regards to how much you owe. So you 25,000 upside down. Well, what the short sale actually does is allow somebody to come in as an investor and purchase that house, let's say maybe for $60,000. And the mortgage servicer will relieve you of that difference. They won't come after you for that difference, right? And so that's what that short sale is, right? Now, keep in mind, just to give you a quick idea for my investors that's out there, or those who are thinking about being an investor, like the property that we had out in Slidell, that investor bought the house all cash for $65,000. Was nothing wrong with the house. I had a new AC system in there, new roof in there. The only thing that he did in that house is touch up the paint or maybe change the colors in the inside. He probably updated the garden on the outside, and that was it. He bought it for $65,000 cash. The house was worth $120,000. So immediately he had equity in the house. But this investor, he actually kept it and he actually lived in it. So for those of you who are thinking about real estate investing, or you are already investing, those are ways that you can give back to the community, because he could have turned that property around, put it back on the market. It would have been a beautiful home for somebody else. While my wife and I moved out into another house that we bought from a bank that was REO, right? And so that's what a short sale is. A next mitigation option could be a bankruptcy Chapter 13, right? There's a automatic stay goes in place, right? Like we stopped foreclosure like the day of, literally, right? Down in New Orleans is at the City Hall, pretty much. What's the building on the corner of Poydras and Rampart? I think that's Rampart. But it's an open sheriff sale, and if the public is welcome to be there. And I want to say it's 12 o'clock that it happens, right? Now, oftentimes, if you file a Chapter 13 bankruptcy on time, it's an automatic stay. Even if it's an hour before the sheriff sale, they have to stop that sheriff sale in regards to your homes being foreclosed, right? And that's called a Chapter 13 automatic stay. But you could start with your bankruptcy attorney, but that is an option to give you some time to get your money together so you could repay it, or give you some time if you want to sell that house, right? So that's another mitigation for you. And also the loan modification. We heard those two words and that term many different times back in 2008, 2010, 2014 is loan modification. But you have to be aware that it's really difficult to get a loan modification these days, right? And what the bank does is, not the servicer, not all of them, but some of them, in particular in my experience, they will drag you on, right? And so that's what they was doing me. I was going through the loan modification process. I was sending in the documents. It's almost like doing a whole new home loan. And I was giving them bank statements, paycheck stubs, and then I'll follow up a week later, see what was going on for update. They'll tell me, oh, we didn't receive the documents, Mr. Chambliss. I'm like, well, how the hell you did not, receive the documents? I sent it twice already. So now I'm sending it a third time. And I'm thinking they received it. All of a sudden they tell me again, we didn't receive the documents. But everything is okay. Don't worry. We know you, we're working through the process. And next thing you know, the sheriff was knocking on my door. There was foreclosure on my home. So you don't want to put yourself in that position where you're trusting that service provider. You want to be proactive doing what you have to do, right? And that's what was found back in 2009, 2010, even closer now to 2021, is that the loan modification process is tough sometimes, right? It's tough to get approved, and you have to know that. But some do go through. But don't put all your eggs in that basket. That's all I'm sharing with you, right? You want to be proactive, right? Because at the same time, the bank have these two, well, the lender, the servicer have these two train tracks that's going down the same road, right? One train is the foreclosure and one train is the loan modification. But here's the thing, whichever one hit first wins. So if that foreclosure hit, then that foreclosure is gonna win. And so if that servicer is dragging a leg along with the loan modification getting approved, you might lose that battle. So if they have now that's illegal now, right? That's what the act came into place, where they can't have two train tracks rolling at the same time. But the caveat is, or the secret to that is that as long as that servicer don't have a complete loan packet, then they can still keep those two train tracks going. So in other words, if that loan servicer received all the information that they need to complete that package so they can make a decision, if they do receive that foreclosure has to stop. Absolutely must stop. That's the law now. But of course, being creative, some, not saying all, some of the services say, well, we're just not going to collect all the packets, right? And that's what they was doing me. Hey, we're not going to collect. We didn't receive it, Mr. Chambliss. We didn't receive that one either, Mr. Chambliss. So that way that foreclosure kept moving forward. So I hope, those 5 mitigation options are to be able to help stop or avoid a foreclosure actually help you guys. And I hope you were taking some notes as well. So make sure that this is being recorded. So make sure you can rewind later on, get that information and pass it along to somebody else, right? So let's talk about, how to prevent that, right, Veronica? We talked about, what you do in the midst of going through a foreclosure or in the midst of going through a forbearance. And we share this information because we mentioned earlier that in March 2021, the forbearance ends. So there's going to be a lot of people in a tight spot, and that we have to be aware of. We can share this information with to help them. But let's find out, how can we be proactive, right? And so when you purchasing a home, you had a personal financial plan in place. You worked on your credit and your credit score was high. You worked on your savings and your savings was high. You worked on your debts and your DTI ratio, or your debt to income ratio, was low, right? And so you had this personal financial plan. But you want to keep and maintain that same personal financial plan once you actually get the keys in your hand. 2 years down the road, 10 years down the road, you still need that personal financial plan. That way, if something gets rough and you lose your job, you might have a savings that can save, that you can tap into that savings and pay your mortgage for, right? So 2 financial strategies that we share all the time that people need to be aware, that everybody wants. The first financial strategy that we want to live for today. We want to pay all our bills and have money left over so we could do some fun things, right? We could go vacation with the family, buy the children something, help mom and dad, whatever you want to do, right? Help some of your siblings, give back, and just be a community activist, right? Whatever you want to do, you just want to have the money to do that without stressing, right? And so the second objective is the future. At some point, you want to retire, you want to start working, you want to live the same type of lifestyle in the future like you're living today, but you don't have to work for that income. So there is 4 challenges that we have to understand and know. Number 1 is taxes. Taxes is a challenge that we have to know and overcome. So when you're a W-2 employee, when you're working for somebody, you're being taxed the highest, anywhere between 23 and 33%, meaning that a third of your income is being taken away from you through taxes, because you go to work, you pay taxes, and you spend money on what's left over. Then you have other individuals that may be self-employed. Well, they build their business, they generate income, they pay everything or buy everything they need, and then they pay taxes on what's left over. So taxes is a big, big deal. The next challenge is debt. A lot of people are in debt. So we want to owe no man anything, right? We want to minimize our debts as much as possible. Thirdly is credit, right? People with bad credit scores or high interest rates, meaning they're paying for a different product or service that I'm trying to obtain. And then lastly is consumer spending. Some people have a bad habit of just spending things. And so the solution to that is to have your personal financial plan in order. You want to minimize taxes. You want to minimize your debt or pay off your debt. You want to create cash flow that's coming in from a side business. That way you can have your income coming in from your W-2, but have the side business coming in that you can write off certain things, right? And then lastly, you want to make sure that you have your savings account being saved. So those are the things, guys, that help you to be proactive in regards to not getting yourself in the position for foreclosure. Now, we do understand life happens, things happen, and hit you on the blind side. I get it. But at the end of the day, you just can't put your head in the sand. You can't become an ostrich. You can't get embarrassed. You can't think that this thing is just going to go away. It's not going away. You have to deal with it. I had a mentor tell me a long time ago, until you handle it with grace, it will stay in your face, right? And so you want to handle this thing with grace. You want to reach out to some professionals, people that can give you some guidance, people who've been through the struggle, so they can say, listen, you need to do A, B, and C, so that way you are comfortable with your plan. Another mentor told me a long time ago is that you plan your work and you work your plan. And so we gave you guys today a plan. Now, if you're in the midst of foreclosure or you're in pre-foreclosure, then you need to work your plan, right? Feel free to reach out to us. At the end of the day, we're here, we're available. And so that takes us to the next section of the show. And that is the quote of the week, right, Veronica?
Yes, sir.
All right, so here's the quote of the week, guys. Failure means you have now learned another valuable lesson that pushes you one step closer to your goal. I'm gonna read that again. Failure means you have now learned another valuable lesson that pushes you one step closer to your goal. So Les Brown said, listen, if you get knocked down, make sure you land on your back, because if you can look up, you can get up, right? So having said that, we're going to provide a free consultation, guys. We have a no-fee guarantee. So if you're looking to purchase a home, if you're looking to buy your first home or invest in real estate, we're here, we're available. We give you a consultation on the phone. We don't charge anything. We ask questions. Even if you know somebody or you yourself is in pre-foreclosure and you need some guidance, we have a team in place. These are foreclosure prevention specialists. They can help guide you through that process as well. Again, the Louisiana Housing Authority, that website is lahousingauthority.org. You can learn more about our mortgage process and the loans that we have available at randyknowsmortgages.com. You can follow me on Instagram and Facebook. I'm known as Mr. Randy Chambliss. And my direct number is 504-270-2783. And Veronica?
Same for me, guys. You can follow me on social media at Veronica Chambliss. I can also be reached at 504-715-4388. And my website is vknowsmortgages.com.
All right, awesome. And also make sure you follow us. We have a page for the Mortgage Wise radio show that can be found right on Facebook, the Mortgage Wise radio show. So every Tuesday, most high willing, we're going to be here at 7 p.m. Central Standard Time. We're going to have some subject matter experts that are going to be coming on the show. So make sure you guys tune in each and every week. Tell a friend, like the video, share. God bless, and have a great afternoon.
And like our page and share that. Thank you.
Awesome.
Thank you, guys.